Hello guys, welcome back to another YouTube video. Hello guys, welcome back to another YouTube video. In this video, I'm going to be going over my trade review on Friday, the 13th of June. And essentially I'm going to be covering the entire process of how I was able to have a bearish bias capture a trade of over 7 units to a word in the New York AM session in going into the PM session on Friday, June the 13th. Now, on the daily chart, which is where you should start most of your intraday analysis, you want to be on the daily chart. As you can see, Friday was the only day in this week that was an expansion. And I caught that trade. And I'm going to go over the process of how you could have too. Now, everything I'm talking about in this video is utilizing ICT concepts, and it's mostly ICT concepts. It's based on ICT concepts. And this trade could have been taken without quarterly theory concepts, even though I am a quarterly theory trader. This trade, the entire framework to the settings, to the entry, to the narrative, everything is ICT. So starting from the daily chart, first off, we have this daily SIBI. This is a daily bearish fair value gap. And if you extend this, you would clearly see that Wednesday, which was the midweek, traveled into this. Now, by the time Wednesday traveled into this bearish fair value gap and it closed as a consolidation candle, this is a reversal candle, right? And we took the previous week's high. Here above the previous week's high. We took the previous day's high. This is the previous day's high. And we closed inside of it. I would classify this as a midweek reversal, and I would be expecting Wednesday to be the high of the week. And I would not expect any other day, be it Thursday or Friday, to expand past the high of Wednesday. On a normal day, of course, given the right conditions. Now, we have the true week open, which was Tuesday's open right here. And considering the fact that Wednesday formed a reversal and Thursday did not expand lower, it expanded lower, but retraced and came back above the open. So it opened lower, right? And London probably opened lower and traded higher during the day and closed. Now on Friday, we're expecting bearishness. And we're going to go down to the lower time frame, but just take a minute, pause if you have to, and digest the structure of this week. This is where the week started from. This is Monday, Tuesday, Wednesday, Thursday, Friday. Wednesday formed the high of the week. We're expecting Tuesday and Thursday. We're expecting Thursday and Friday to go lower. Now, I'm going to go over the draws and liquidity and the areas in which I was expecting price to expand to and get to during the trading session on Friday in the New York. Now, after we took this high, Wednesday expanded lower. Thursday consolidated. We want to go down to the 4-hour chart and see actually what happened inside of these daily candles. Now, if you go down to the 4-hour chart, you will clearly see that we have the previous day's high. This high, this candle is already inside of Tuesday. This is Tuesday's high right here, the 6 p.m. high. From 6 p.m. Tuesday, that is already the Wednesday daily candle, right? So this is the Wednesday daily candle, and this is the Wednesday open. We traded higher in the morning session of Wednesday, and we closed below. Two very, very large wicks. So this wick traded into the premium of this wick in the same day. So Wednesday was very, very volatile, and we formed a midweek reversal. Now, what we notice is that the 2 a.m. and the 6 a.m. candle of Wednesday were bullish candles, and we closed below those candles by still in Thursday actually. And then we had this new day opening gap below this, and this candle closed below. So that makes these candles a change in the state of delivery order block, which I marked out right here. Up close candles, down close candles. ICT describes a change in the state of delivery as a close below a set, or a close below or above a set of opposing candles. Now, up close candles, down close candles are opposing. So when you have a close below, that is a change in the state of delivery. Most especially when those candles closed above. If you notice, the close of this candle is higher than the previous close. It's higher. So this is the change in the state of delivery right here. if we closed below these candles, this will not be a change in state of delivery because this candle is the highest closed. So that also is one thing to keep and take note of. And after we close below, formed a reversal inside of this change in state of delivery. On Thursday, I was expecting bearish action in the New York session, but I did not get that. And then we expanded very violently around 8 p.m. on Thursday. And I was not expecting any of that, so I did not trade any of this. So the if we go down to the 1 hour chart, this is where we now get into how I was able to build my structure and actually build the idea behind the particular PD arrays that I wanted to focus on in trading this session and the New York AM session. The New York AM session starts at 8 a.m. right here. So I was able to capture this entire move downward, which if you measure is about 250 points. The entire move was around 250 points, 254. So I was able to capture this entire move, and we're going to go over how exactly the PD arrays I use and why I picked those PD arrays and the logic behind picking those PD arrays, and going into the lower time frames and actually aligning those PD arrays with other PD arrays on the lower time frame and nailing the entry, managing risk, and setting targets and all that. Now, first things first, you're just going to notice that this is a very nice fair value gap right here. That's like the most obvious thing here. It's a very big fair value gap right here. It's like very obvious, you can't miss it. Going just off of that, unless you're a trader who, I don't know, has a very, very large risk appetite, this is a very, I wouldn't say this is a very appetizing trade to take, right? It's not really appetizing. It's like 1.7 risk to reward. You have a very large stop and you're not really capitalizing on the move of the day. So that being said, we have this fair value gap right here. Where does this fair value gap lie? The fair value gap lies just around the true week open. And I was really looking at this true week open to short below it, because when the New York session opened and we manipulated, traded higher, there was a lot of things that I could talk about, but this video is going to be too long. So I'm just going to focus on the shorts and how I took the shorts. Now, we had this fair value gap, which is also really big. We have the consequent encroachment. So another thing that I used to narrow down the area that I wanted to be focusing on was new day opening gaps. Now, if you go to the regular trading hours right here, you will notice that we were trading inside of a new day opening gap. Now, if you take this new day opening gap from the close of this candle to the open of this candle, you will see that the consequent encroachment, which is the midpoint, half point, we traded above it. Another thing you could have measured is this right here, which I did measure, which I did take into account, was this new day opening gap. Now, if I take this new day opening gap off, you can see right here that the consequent encroachment of this new day opening gap, we never ever closed above it. You can see we closed right below the consequent encroachment of this new day opening gap, which is a ICT concept. So that is a regular trading hour new day opening gap. Now, this candle that never closed above it, the 1 hour chart, is the 11:30 candle. Now it's showing as 11:30 here because I'm on the regular trading hours. If I go back to the electronic trading hours, it's gonna, show that. Let me go back to the regular trading hours so I can actually mark this out and then go back to the electronic trading hours, so you see how it displays and how it renders on the regular trading, on the electronic trading hours. So we have how many PD arrays? There's a lot of PD arrays here. Okay. So we have this new day opening gap from June 9th. We have fair value gap. We have new day opening gap from June 13th, which was essentially Friday's new day opening gap on the regular trading hours. So these were the three PD arrays that I was looking at in conjunction with the true week open. Now, what do you notice about this zone? You will notice that everything concentrates around this area. Everything, the majority of the PD array that I was focusing on concentrates around this area. Now, if you notice, I haven't looked at SMT. I haven't really talked about SMT because most of the week has been consolidating. SMT and sequential SMT is very useful in targeting expansions. But when the week has been consolidating, there's lots of opposing SMT. You could have SMT below and above, and it gets really confusing. So that's when it's important to actually know your ICT PD arrays and know your ICT structural principles and all that. So based just off of this, you could focus on this area and just focus on this when the market gets into this area and look to take shorts, just based off of these concepts that I just talked about. Now, from the 1 hour chart, I'm going straight to the 5-minute and the 1-minute chart. I'm not hanging around the 15-minute, not hanging around the 13-minute, because I have no business there. I'm going straight to the 5-minute chart. And what am I looking for? Well, inside of these PD arrays, you can see it's a really high concentration of PD arrays. And, if just for the purpose of illustration, I'm going to leave them on, but I'm going to have to zoom in so you can actually see what it is. So I'm going to make the fair value gap red. I'm going to make the regular trading hour thing, I'm going to make this orange. I'm going to make the bigger regular trading hours, I'm going to make that purple, and I'm going to make the true week open nothing. I'm just going to leave the true week open there. So looking at this, you can see right here, I marked out this SMT, and this SMT, essentially, as small as it is, right? The SMT spans from this high to this high. As small as it is, it doesn't look like it's so significant, but it's really, really small. If you look and compare this to ES and YM in the 5-minute chart, I make this change to the time, interval, and then the date range. If I go back here, you can just see right here that ES took the high, but YM did not take the high, and YM peaked at 11:30. So YM was starting to capitulate at 11:30, and you can see we had a much larger dump on YM, right? And truth be told, I would have been, made lots more profit trading YM. But I do not trade YM, and that is one of my rules. I stick to the NASDAQ, and I always trade the NASDAQ. So focusing back on the NASDAQ, we already have SMT. Cool. What do we have after SMT? Well, a change in the state of delivery confirms SMT. And on the lower time frame, you can see we have this change in the state of delivery. Now that we have all these PD arrays, I'm going to move them out of the way so we can see exactly what it is we're dealing with. So you have these concentration of PD arrays. Now, let's focus on the price action. Inside of this, we can see that this true week open is the major concentration. And once price starts to close below this, we can take confirmation and be like, okay, we're not expecting price to again close above this and start to expand higher, which is the entire point of a stop loss. You put in the stop loss there because you don't expect price to get there. Now, we train delivery state. Where is your stop? Your stop can be anywhere from the, if you have the progression, it can be anywhere from the bodies of the change in state of delivery order block, or straight to the high of the change in state of delivery order block. My stop was at this high of this big bodied candle. Why? Because that was an expansion candle and it's an engulfing. Now, it's also important to study your candlesticks, because with an engulfing, you're not expecting price to trade above that engulfing, because everything that came before it was consolidation. Anyway, that's not what we're here to talk about. After this change in state of delivery, this is the first setup you could just look at and be like, okay, this is a trade I would take. Because once we change delivery state, you can take a short right here and ride the short all the way to these lows, because we have this. You can technically say this is buy side, and then this will be sell side, and we trade all the way down into sell side. My target was at this rejection block, because I don't really like to trade, especially when we have low wicks and candles that are really large like this. I don't like to trade all the way to the lows. I will most times take profit right at the close of the last bearish candle, which also aligns with like this thing right here. But that's just something minute. Now on the 5-minute chart, let's forget about risk to reward. Let's focus on the structure, right? Because focusing on structure will actually help you take much more high quality trades, because you're going to be focused on price. You're not going to be focusing on the reward or how much you're going to make. Now, we had SMT, we had the change in the state of delivery. What else were we looking for? Well, if we have the SMT and change in state of delivery, We're usually looking for fair value gaps as probable confluences, and you don't really need much more than that. My personal entry was on the 1 minute chart, right? So we've talked about the 5 minute chart and how you could have traded on the 5 minute chart. On the 1 minute chart, if you look right here at the top, this high was made at 12.18. Not really important. What do we have here? Fair value gap. Now, ICT mentions stuff about fair value gaps when price is trading into fair value gaps and is not closing above the consequent encroachment and is rejecting the consequent encroachment. This is a bearish signal. It's a bearish sign, and you can actually look to take shorts. So if I was trading on the 1 minute chart, which I wasn't really trading on the 1 minute chart, I was more focused on the 5 minute and the structure of the 5 minute. This could have been another entry, taking this entry really low risk, but I wouldn't really advise this unless you're willing to, maybe if you're a flipper, you're willing to lose on this trade. Maybe you get wicked out and then you short again. The best trade was the trade I just showed on the 5 minute chart. So if that's enough for you, you can literally just close the video right now. But on the 1 minute chart, we have this fair value gap. A short could have been taken here. After that fair value gap, we have this close below. That is a change in state of delivery. Another short could have been taken as soon as we change delivery state, before price even got to this fair value gap. So maybe if you came to the market when price got into this fair value gap and you see this change in state of delivery, you can safely enter here and put your stop here, because essentially you're trading a setup of this change in state of delivery. So trading down below, we traded and created this fair value gap, and we traded into it, traded out of it. My entry was right at this fair value gap right here, because remember, this is the 5 minute change in state of delivery. I'm going to change it to 5 minute change in state of delivery, and I'm going to increase the size. This was the 5 minute change in state of delivery. We had this fair value gap, traded into it. My entry was here. And some of my accounts that I had, 2 other accounts, my entry was around here. And my stop was right at this high. Remember, the bearish engulfing candle, this was my stop. And you can see price got really close, but it never got to the stop. So these were some first level entries, and then some continuations after price took this high was right here on this inverse fair value gap, and we traded higher. I usually really like inversion fair value gaps for continuation trades. And when you sweep a high, you could also take it as a turtle soup entry. There's so many entries you could take on this framework, but I don't want to, bulldoze the entire place with so many lines that you don't really know what you're focusing on. There's too many things you could have done with this market. The structure is really clean, really nice, and had these fair value gaps, this inverse fair value gap, short from here, another short. Like I said, the risk to reward does not matter. All you need to know is your entry and your exit. Entry around this level, exit around this level. The risk to reward doesn't really matter. It's a lot, but to be honest, it does not really matter. What matters is that you're making money. Now, we traded into this, traded out of it, traded all the way down, and you can see this very violent wick trading back into our entry. So that's another sign for you to not be setting break even, because break even is very useless, to be honest. Like, break even essentially is you saying that you are not accepting the risk and you don't want to lose. Break even, because if I had set break even, I wouldn't have made any money on this trade. But I did not set break even, and I did make money on the trade, because after we traded back into the entry, we traded out of it, and then all this continuing, and there was another entry right here. I don't really like talking about these entries because a lot of times the patience required to wait for the perfect entry on a continuation after the trend has already started it's really hard, and you can enter at the wrong places and get stopped out. Maybe if you put your stop at the wrong places, especially with this really large wick, like you can't really enter here because price hasn't really given anything. Also, if you're trading quarterly theory, I'm pretty sure there's like an SMT here somewhere. Like, if I open up AS and YM, there's probably SMT here. I mean, there's no SMT, but again, that's why you really want to be on time to catch the main trade before the bus leaves the station. And that essentially is it. that is how I caught this trade. And we're consolidating now, and I do expect price to go much lower going into next week. But that's it. That's basically it. There's nothing too complicated. If you study this, do it, study it every day, you're probably gonna get it in a couple months too. That's basically it. So I'll see you in the next video. Have a good one.